Welcome to the Miles Financial Show with Billie Miles. Billie is a co-founder of Miles Financial Group, and for over 20 years, Billie's consistently been a leader in his field as a producer, mentor, and trainer to thousands of advisors nationwide. He's a member of the National Ethics Association, and he is an expert in no-market risk strategic planning. The Miles Financial Group specializes in working with people who are in or near retirement with wealth management, income planning, and asset protection strategies. And now, here to talk with you about tax-free income and retirement, your host, Billie Miles.
Hello, this is Billie Miles, your host, welcoming you to the Miles Financial Show. I'm an asset and retirement protection specialist and partner and co-founder of the Miles Financial Group, your one-stop source of no-market risk strategic planning.
So we're talking today about mistakes, and we all hate making them, and some of us might even be downright afraid of making them, at least as it relates to our money. But of course, mistakes have a widely varying degrees of consequences, right? Your footsteps on the gas a little too strong, and you may get a speeding ticket, or you lose track of a bill and have to pay the late fee. And then there are those big mistakes, like not taking retirement planning seriously. And the number of potential consequences from making this type of mistake can be astronomical. And so that's what today's show is for. People who are worried about making a mistake with their money, specifically their retirement money. And frankly, that includes the majority of people that we talk to on a day-to-day basis as they're moving closer and closer to retirement. They're so concerned about making a mistake that can ruin their retirement and ruin everything they've worked so hard for. But you can bet one thing for sure. The move from the paycheck mode to the retirement mode, it can be a stressful event. However, it does not have to be as long as you have a plan in place, because we encounter a slew of life changes when we decide that it's time to stop working. And one of the big changes is in the way that we handle our money. And so we need to make sure that we don't whiff on some of the major financial decisions that we'll need to make before we retire. For instance, how much have you put into the different ways that you may pay for healthcare or long-term care when you move into retirement? Did you know that statistics say that 7 out of 10 people, a full 70% of seniors ages 65 or above, will have to use some form of long-term care, whether it's in-home or inside of a facility? How will you pay for that? What are the options or choices that you have available to you? Do you know about how much you will have in Social Security to be able to count on? Have you thought about the 567 different ways that you'll have to plan to be able to take Social Security? Because the reality is the opportunities abound for making mistakes if you don't have a plan. So on today's show, we're going to look at 3 big ones that I see people make often when they retire and as they're leading up to retirement. But know this, there are far more than 3 mistakes that we could ever possibly cover. But for today, though, I want to focus on the big 3 and look at what you can do to help avoid making a major financial mistake before you even get started into retirement. And these are all money mistakes that some people make before retirement, and some of them are mistakes that you can make even after you've already retired. They may be looked at as the big ones. In order, the first is investing too conservatively. A lot of clients, especially with the economic climate that we're in right now, they make the mistake of moving all of their assets into cash or into some low fixed rate environment where they're earning maybe 2 or 3%. The challenge with that is you're actually losing money every year just through the impact of inflation. Mistake number 2 is screwing up the lump sum versus pension decision. And the third is focusing too much on our retirement assets instead of on your retirement income. You see, each of these questions can have significant implications for your retirement. And so today we'll take a look at each one in some depth, and we'll put some meat on the bones of each of these topics as the show unfolds. Because, lots of people just can't live with the volatility that was once perfectly okay for them. When you're younger and you're moving up the corporate ladder and you're well within the accumulation phase of your life, you can afford to take some risk, or you're more willing to take risk. As you get older and you move closer and closer to retirement, things change. And what was acceptable at one time makes us nervous at another time. If you're nervous about the retirement savings you have in today's stock market, you'll be happy to know that you're not alone. many people are nervous. And for those people, it's important that retirement savings alternatives exist that are completely independent of the stock market. Alternatives that can generate significant retirement income while protecting your assets from market risk. And clearly knowing about these alternatives, they can have a big impact on the way you look at retirement planning. So if you'll give me a call, I'll share with you some of these alternatives, and I'll help you by performing a complimentary retirement income analysis, an analysis created and customized just for you. This retirement income analysis is 100% complimentary with no cost or no obligation, and it's designed for people that have saved at least $100,000 for retirement and are planning to retire within the next 5 to 10 years or may have recently retired. So give me a call right now at 909-321-9737. That's 909-321-9737. And make sure you ask for a complimentary copy of my Conservative Investor book. It's 115 pages of everything you need to know to plan for a successful retirement without risking all of your assets in the stock market. Again, that number is 909-321-9737. So today we're talking about mistakes in retirement that you can make sometimes before you even realize it. And one of them is investing too conservatively in retirement. And it's the first mistake that we're going to look at today, because after all, this is about how you invest your money. This is a mistake that's often overlooked for most clients that we sit down and talk with. And it's often a telltale sign of a lack of investment discipline. So be sure from the beginning of your retirement journey that you make sure you focus on this one because it's important. The question is, are you taking enough risk with your retirement investments? And let me be very clear about what I mean by that. If you can invest your assets and do so in a safe manner that still returns greater than an typical inflationary return, 4, 5, 6% or more. Well, now you've kind of eliminated a lot of risk from the portfolio while still giving you an opportunity to generate acceptable or what we call reasonable rates of return. And that's what most people are kind of surprised to hear, because most people are expecting to hear caution about investing too aggressively in retirement. And we can rely on the conventional idea that we're supposed to become more conservative with our retirement assets as we get older and our earning and saving potential decreases. After all, don't we need to worry about how adverse market conditions are going to affect our portfolios? Absolutely. That still holds 100% true. However, we see way too many people and way too many advisors, or another word for that would be financial salesmen, going overboard here in our opinion. The point is, don't get too conservative. The mistake we make sometimes is that we completely remove market risk from your portfolio altogether. And those who do this are folks who simply can't fathom the idea of losing money in retirement. It scares them to death. And there are a number of ways to make this mistake, such as one is to have too high of a percentage of your money in the bank, earning little or no interest at all. Another way is having too much money in government treasuries or bonds, making very little. It doesn't matter if you have a short-term bond or a 30-year bond or long-term bond. They're all within the 2 to 3% range right now and sometimes lower. A third way is to have too much money inside fixed products like a fixed annuity. And still another way is to allow too much money sitting in stable or fixed value funds and mutual funds or inside of employer-sponsored plans. And then finally, too much money sitting in CDs that are paying little to no interest. The fact is things change. And lots of people just can't live any longer with volatility that was once perfectly okay for them. So if you're one of those people, if you're nervous about your retirement savings that you have in today's stock market, you'll be happy to know that many people feel the exact same way. And the fact of the matter is, you can eliminate that worry by having a diversified portfolio that allows you to be able to sleep easy at night, have peace of mind because you have a plan. That's the most important piece. Do you have a plan to deal with the market when it becomes volatile? Is your plan to simply move 100% into cash and to stick your head in the sand and wait for the market to come back? Typically, when people do that, they miss out on 30, 40, or 50% of the growth of the market in the recovery phase. And so you don't want to act have a reactionary plan. You want to have a proactive plan. And that encompasses diversifying your assets with a mixture of assets that may still be at risk, some assets that give you 100% principal protection. So you're guaranteed that you can never lose money, especially for those assets that you'll need to provide long-term income for you for the rest of your life. And then finally, making sure that you have enough liquidity, making sure that you have enough assets that are independent of the stock market, independent of what you need to draw upon for regular income and monthly expenses, that are just pure liquid assets or cash that you can use at any given time. So if you're in that situation and you're concerned about retirement and what you should do with your money the closer you get to retirement, then give me a call right now at 909-321-9737. That's 909-321-9737. If you saved at least $100,000 for retirement, you qualify for our complimentary, no obligation retirement income analysis and a copy of my Conservative Investor book. So give me a call today at 909-321-9737. That's 909-321-9737.
Well, I have to take a short break. This is Billy Miles, and you're listening to the Miles Financial Show. So let's pause for some exciting announcements.
What if you didn't have to wait any longer to retire? Fed up with the 9-to-5 rat race? Daydream about retirement when you're stuck in rush hour traffic? Maybe you don't have to wait. Let Billy and Patrick Miles and their team at Miles Financial Group help you answer the question, when can I stop working? With their personalized retirement income analysis. The results might delight you. This personalized retirement analysis outlines successful strategies on how to achieve financial peace of mind, whether you are still working or already retired, offering guaranteed income plans for life. Plus, discover some tax and estate planning strategies on how to pass along more of your wealth to your children and grandchildren. Typically, you'd pay hundreds of dollars for this service, but right now, it's absolutely no cost to you if you have at least $100,000 saved for retirement. Call for your complimentary, customized retirement analysis from Miles Financial Group right now at 909-321-9737. 909-321-9737. Billy and Patrick's team is dedicated to helping you develop a guaranteed income plan that can't be outlived. 909-321-9737.
AM 590, The Answer.
Welcome back to the Miles Financial Show. I'm Billy Miles, a safe money retirement specialist.
So again, today we're talking about the 3 biggest mistakes that you can make leading up to or in retirement. And we just run down one of the biggest money mistakes we see clients make all the time, and that's investing too conservatively as they get to retirement. The second mistake is making the wrong choice as it relates to the lump sum versus pension decision. And we see this one frequently as well, because hundreds of companies that have traditionally offered their employees a pension plan when they retire are choosing instead to offer a lump sum buyout choice in addition to the pension choice. In a nutshell, these companies are allowing employees to forgo a pension in return for a lump sum that you get all at once. And for some people, quite frankly, that may sound appealing. But in some cases, it's the right choice. In some cases, it may not be. And this is a tough decision that shouldn't be made quickly. I've seen many cases where taking the pension instead of the lump sum made total sense. It was absolutely the right choice to make based upon the data and based upon the math. But I've also seen circumstances where taking the lump sum instead of the pension was the best financial decision. So it really depends on a few things. For starters, the offer itself. Is the offer any good? Some are better than others, and they certainly aren't all the same. For instance, one offer might give the client $500,000 in a lump sum or $2,500 per month. A different offer might give that same client or that same $500,000, but they may only offer $4,000 per month in terms of a guaranteed monthly pension. And so each offer must be considered differently in light of the circumstances. You also have to take in consideration, what do your other liquid assets look like? Do you have a 401k, 403b, or 457, or some other type of asset that you can utilize to supplement your income in retirement? All of that has to be taken in consideration. And then finally, Social Security has to be factored into a comprehensive financial plan before you make any decision. You see, every successful retirement starts with a strategy. And part of that strategy is